Warren Buffett and Charlie Munger are widely considered to be among the most successful investors of all time. They've been business partners for decades, and they've seen incredible growth with the investment vehicle and publicly traded company Berkshire Hathaway. Recently, Charlie Munger came into the news as he bought a little bit of Alibaba stock with one of the companies that he helps oversee, which is the Daily Journal company based in Los Angeles. And this prompted me, seeing this news made me ask if I should actually buy more. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find exceptional companies and unrivaled investments. And I've actually owned Alibaba for a little bit. And so seeing that one of the greats has actually decided to start buying made me wonder if I should be buying more, and made me think, hey, we should revisit the valuation so we could properly understand what's the risk reward. And so I wanted to make a video about that so that you can see what the risk reward potentially is and what Charlie Munger is seeing as he's investing. So should I buy more? And so first, you need to have a little bit of perspective, which is this Alibaba purchase, as reported with the Daily Journal. It's only $37 million. I say only $37 million because, you're dealing with the major leagues over here where, if you look at the Berkshire Hathaway portfolio, this is $280 billion equity portfolio. So this is almost like a rounding error. Now, it's not the same vehicle. This is Daily Journal, but it is, it's relatively small potatoes, small chips relative to what these great investors, are familiar with and have done. So if Charlie Munger had talked Warren Buffett into buying it, I think you would have seen it at Berkshire, and it would be for a much larger and more material stake. And so why has Alibaba been in the news lately? So first of all, in the last few days, you've seen a record fine paid where regulators have slapped a $2.8 billion fine, effectively determining that they had abused their market position, trying to do monopolistic tendencies. This really comes about from several lawsuits from other competitors in the e-commerce ecosystem where Alibaba had forced certain merchants to choose which platform they wanted to work with. And, another example of Alibaba being in the news for the wrong reasons were a few months ago, they pulled their Ant Group filing following a speech that Jack Ma, the founder of Alibaba, had made, where he had said, and also the founder of Ant Group, which is their financial subsidiary that provides like microfinancing and loans to merchants as well as individuals, along with a whole bunch of other things, where he was critical of the financial system in China, suggesting that there's potential for significant improvement or even potentially revolution. And this obviously got the Chinese Communist Party upset, and so the Ant Group financial IPO was pulled, and Jack Ma sort of went missing for a few weeks. He subsequently reemerged, but his public scale has been toned down significantly since then. So that's the second, I would say, strike two. And then strike three is here. It is after this IPO was pulled. You see that this Ant Group, they've had to sort of restructure their business based on the regulator saying, you know what, you're not going to be able to do this. You're going to need to have new different types of licenses. And based on some people's estimates that they're saying up to 60% of Ant Group's revenue could take a hit because they will no longer be able to do some sort of the cross-selling that they'd previously been able to do. So this is part of the Chinese government anti-monopoly plans. So you see all this sort of negative headlines. You see this Ant Group's rectification plan. You see Jack Ma, he has to go into hiding. They pull a major IPO of this Ant Group. You see a major fine of several $1 billion, and it makes you wonder, despite all these negative headlines, why would Charlie Munger be buying? Now, keep in mind, Charlie Munger's reported purchases for the Daily Journal, that was that was for December 2020 or that period. So that you're not looking at the latest financials. This is this isn't based on the last week's data. That said, he's a long-term investor, so it's unlikely that it's going to be that he's sells in and out of this based on this news. I'd largely suspect he anticipated some of these things. So why is he buying despite what some would argue are really terrible headlines? And, this is where you start actually needing to understand, well, what is Alibaba? And you should understand Alibaba is a behemoth. I mean, it puts every other company in terms of scale to perspective, where, they have 902 million mobile active users, nearly 800 million active consumers, and their share of retail sales in China has continued to grow. I mean, you're talking about a multi-trillion-dollar market, and they've continued to take market share over time. And when you look at this behemoth, they have so many different business segments. I mean, it would be impossible to break all of this down in one YouTube video, one 10 to half hour long YouTube video, just because there's so many different segments. You have segments that are focused on consumer to consumer versus business to consumer versus effectively fancy grocery stores or remodeling certain types of grocery stores. They have international e-commerce, logistics services, they have wholesale solutions, cloud computing, digital and media and entertainment. They also have a web browser. So there's a lot and they also have several new initiatives where like live streaming short videos and that tie into commerce. So this is, there are so many different bets going on here that's moving this company forward that it's sort of difficult to understand, well, what exactly is going on here? How do we actually value this? And to put this in perspective, their investor day, their most recent investor day, was 3 days long. So this is certainly not going to be just one YouTube video. Their investor day was September 28th, September 29th, and September 30th. That said, what we can do is we can try to value it based on sort of breaking these things apart, looking at individual components. But before getting into the valuation and sort of diving into this, asking ourselves whether or not Alibaba is a, this deep value investment because Charlie Munger has been buying it lately, I'd quick plug where if you're interested in following my personal journey, go to unrivaledinvesting.com, click on journey, where you can see each month I call it one potential multi-bagger type of company that I think can potentially go up hundreds or thousands % over time. I also have my monthly portfolio detail that's usually during the first week of the month. We're trying to build a community of like-minded investors, and there's also exclusive content, much like the exclusive follow-up video that I'm going to post after this one. And if you enjoyed just learning about potential multi-baggers, make sure to hit that subscribe button right now or hit that like button. So let's dive right back into Alibaba, understanding it. And so look at all these different line items. I mean, there's so many different pieces going on here. And so it sort of forces you to ask yourself, like, well, how do you eat an elephant? And the answer is it's one bite at a time, where you sort of figure out, okay, well, what am I going to be digging into here? And so you first see, well, okay, here's their total core commerce business, which, going back over here, their core commerce, they're saying that's the vast majority of their revenue, and it includes all these different things except for cloud computing, digital media, and these innovation initiatives and others. So all of this is in their core commerce business. And so you look at that and first understand, so that's 460 billion renminbi, I should say. And the majority of it is their customer management, which effectively is commissions and advertising revenue that they get from their major legacy platforms like Taobao and Tmall. So that's their legacy business, and that's been incredibly lucrative. But they have been acquiring and expanding into other areas that are much lower margin for now, but have been growth drivers, like the logistics segment, or getting into their grocery segment, where they're trying to make a much improved grocery experience for consumers, where you can just walk into the store and pick it up. It's the idea of you don't even need a cashier at the end. You can just get scanned in. So that's understand. Okay, they're having these other initiatives over time that should be driving lower margins for their core commerce business over time. This customer management business, which traditionally was just commissions, effectively fees from transactions on their platform and advertising revenue, that was very, very high margin. So now that margin is going to be going down as you have these other faster growing line items. And then you also have cloud computing, which is growing very quickly relative to these other initiatives. So most of my focus, if I'm going to break this down, is going to be, okay, what's sort of a back of the envelope for core commerce, as well as understanding what's the potential for cloud computing. And you can see what their profitability looks like. Once again, all of their profitability comes from their core commerce, of which the vast majority is their legacy platforms like Taobao and Tmall. Whereas, and whereas you could see it's been unprofitable, all these other initiatives, these other business segments that they call out. That said, they are expecting their cloud computing effectively to start breaking even or be profitable in the upcoming year. So, as we dig in and start thinking about valuation, and this is part of my value proposition to YouTube subscribers, so please make a point of subscribing, is that I put this valuation sheet in the description of the video. So you can click on it and play around with assumptions as you see fit. And so for this one, what we're looking at is you're looking at their core commerce segment, trying to figure out, well, how much is this segment worth relative to the total valuation of the business currently. And so you can see how much it's grown over the last few years, growing from 214 billion renminbi to 436. This year, their fiscal year ends in March, and so it's already actually over, but they haven't released their fourth quarter results yet. So based on their year-to-date figures, it's probably going to be mid-30s% growth. That's based on how they've historically done so far. And their optimized margins here are actually a lot lower. That's how I'm penciling out. Now, you could argue maybe I'm being conservative, but they're currently, their margins for the segment are actually mid-30s. I'm using a range of 20 to 25%. So once again, you could say this is being overly conservative, but this is also recognize the direction in which their margins have been heading, where their margins used to be 50%, 40%, now 30s. A lot of this is because they're moving into lower margin segments that are part of commerce, retail sales in China, but it's not as lucrative in terms of pure profit margins as what they started off with, which was pure platform dynamics. And so, you look at that. So I'm putting in 20 to 25% margin. Then what's their growth rate in the ensuing 5 years? And so you can see I'm penciling out, once again, you could say this might be conservative, or you could say this is too aggressive. 12.5% to 20, a little over 20% annualized growth rate in the ensuing 5 years. And then what's the multiple that you would assign this business value if this were a separately traded entity? What would be the multiple you'd give? And so based on their growth rates, based on their margins, if you continue to see margins going down, you might get a lower multiple. So I put 15 to 25 times. Now, what's really interesting here is that this segment, this core commerce segment, based on these assumptions that I'm articulating here, you can see that the upside scenario, and that's how I always try to do a range. I do a low, base, and high. Is that the upside scenario based on, let's say, this 20% plus revenue CAGR, 25 times N multiple, and 25% optimized margins, that gets you to 8.7 trillion renminbi valuation versus their current valuation for all of Alibaba of 4.3 trillion. It's currently, if you were to convert that to US dollars, it's currently around 650 billion US dollars. So effectively, these financials in the high side say, hey, this company could be a multi-trillion US dollar company, certainly multi-trillion renminbi company. And it's interesting to see that this core commerce business, if they continue to execute and do better, let's say, than these conservative assumptions, this segment alone could be worth more than Alibaba is trading at today alone. So not even giving credit to all the other assets that we're going to talk about in a second. Similarly, if you look at the more conservative scenario, which assumes this low teens growth in the ensuing years and a 20% optimized margin. Keep in mind that's nearly a 50% drop in profits for this segment. Now it's about I throw in unallocated costs, which is sort of like overhead into the segment as well. And so you could see, using slapping on a 15 times multiple, which once again, you might argue that's being too conservative. Then, you're looking at 2.6 trillion renminbi valuation for their core commerce segment versus their total market valuation of 4.3. So you're effectively saying, hey, maybe there's 30 something 40% downside just based on their core commerce, not giving any sort of any sort of value to their other segments. And let's talk about some of these other segments. As always, full disclaimer, this is a hypothetical valuation, and the stock price can go way above or way below what I pencil out. I just like to work from a logical framework when I'm doing this, and you can play around with the assumptions as you see fit yourself. And so, next up is looking at their cloud business, where here according to China Internet Watch, literally 40 cents of every dollar spent in China on cloud services, whether or not it's cloud infrastructure, is going to Alibaba. So they're the top dog in terms of cloud infrastructure in China. So if you think more and more companies are going to be spending on their cloud solutions, cloud infrastructure, I mean, that would seem like an obvious play, which is that Alibaba is going to continue to win. Generally the thesis for cloud companies is that it's just so much more affordable than building out your own servers. Plus you get all this tech and you sort of get an ecosystem of developers that are using your platform. So having the scale of being, 40 cents of every dollar that's being spent, that's a big deal. That means they're probably building out an ecosystem of better developers and more applications that's more valuable to the next generation of companies that are going to get launched on China's Alibaba Cloud. So then looking at cloud computing segment, what could that be worth? And, once again, it's growing faster than what we see in, with their core commerce segment, with 80% growth and then 60% growth. And, in the most recent fiscal year, it's probably in the mid 50s somewhere, maybe even the high 50s. And long term, what's their optimized margins, given that currently it's unprofitable? If you look at AWS or Amazon's, cloud platform, you can see that they're currently, between high 20s or low 30s% margins. So, I'm doing a range of 25 to 35% margin, based on, Alibaba having a top position. Then what's their growth rate in the years ahead? Looking at a annualized growth rate of 30 to 40%, you might say I'm too aggressive with 30% on the downside. You might say I'm too, conservative on the upside with only 40% CAGR when it's been growing at, 50, 60% plus the last few years. Longer term, I say 5 years out, value this at 25 to 35 times. Once again, this is a higher multiple than what you saw with their core commerce segment, partly because I'm expecting higher margins, and I'm also expecting higher growth for longer. And so, looking at this, the cloud computing segment could be 3.6 trillion renminbi value on the high side, which is almost the full value of their current market cap. So that's really interesting to think about, that their cloud segment alone could be Alibaba's current valuation. So that does strike me as interesting. Like, well, wait a second. So you're getting this core commerce business and then throwing in this cloud computing business almost for free, and and it's growing super fast. So this is smelling right. I'm glad I own shares personally, and seeing that Charlie Munger is buying is really getting me interested. But there are, even more bad headlines, one could argue. And here's one from a few weeks ago, talking about how China wants to break up Alibaba's influential media business, and how Alibaba owns several, media and entertainment assets, including a stake in the South China Morning Post newspaper, social media platform, video streaming platform Youku, and they have a movie production house, Alibaba Pictures. They have the largest offline advertising network. So the Alibaba is this sprawling behemoth, and honestly, looking at this segment, and it just doesn't move the needle. I did plug it in. You can see this in the valuation sheet. But even in the upside scenario that I sort of pencil out, I'm sort of saying lower margins and 20 times multiple. I am saying that it's not even worth 10% of their current valuation. So in this video, I'm not going to spend that much time focusing on this segment, especially when looking at cloud computing and core commerce really can move the needle and be dramatic, for valuation and potential gains for shareholders longer term. And so, then the next bit, well, what about, this Ant Group? They did scuttle the IPO, but don't they still own a stake? Yeah, they still own, a third of this business. And yes, they had to deal, they have this new rectification plan that's going to result in changed business practices. But here's an article, from Forbes saying, look, yeah, they might not get the $315 billion valuation that they were originally expecting, but now, it might be around $150 billion. So yeah, you're getting a 50% plus haircut. And so, you take this, and so you see, I do a range of 115 to $200 billion valuation. Their 33% cut, converted it to renminbi, and that's over 10% of the value of of Alibaba just right now. And this doesn't really even think like, could this be undervalued? Could this grow significantly in the years ahead? That's just the valuation sort of ascribed to it recently. So that's also strikes me as super interesting. And so you summarize all these different components, and here's the current market cap in renminbi. So this 4.3 trillion renminbi for Alibaba, and you look at each of these different segments, and you can see that it sort of adds up to a very interesting risk reward, where the downside, arguably, if these fundamentals come to pass, and assuming there's no big risks that sort of derail the thesis, assuming there isn't some sort of greater trade war or some other problems that derail this business, or China really the Communist Party clamps down on the business. I mean, this logical framework suggests really reasonable downside risk and really attractive upside risk. And I'd argue this is exactly the type of setup that value investors look for. This is, so it's not surprising to me for me to see one of my life heroes, Charlie Munger, buying Alibaba stock after I've actually bought some for myself, because it's the exact type of risk reward that you'd want with value investing. The whole premise of value investing is that if you get it at a good enough discount, then in theory you limit your downside and you can capture lots of upside. And here it is, the valuation I was just showing was saying, hey, there's potentially a couple of 100% upside and very limited downside. Now there are these macro risks to be aware of, and I'm actually going to call those out in an exclusive video just for Journey subscribers after this, and that'll also talk about what my plans are with Alibaba. But I hope this video has been helpful in terms of thinking about what's the risk reward for Alibaba, what are the different segments, thinking about, wow, this is here it is, this cloud computing segment, 40 cents of every dollar spent on cloud infrastructure in China going to Alibaba Cloud and growing very quickly, 50-60% a year. That alone could be worth what Alibaba is today. So there's a lot of potential here. It's really interesting setup. And if you enjoyed this video talking about Alibaba and multi-baggers broadly, please make a point of subscribing. And if you're already a subscriber, I do appreciate that thumbs up. I'll leave a comment below where with a link for the exclusive follow-up for Journey subscribers later this weekend. Thanks so much for watching.